Welcome back to Marginal Thoughts. Have you ever wondered how some of the world's wealthiest people seem to pay so little in taxes, sometimes, even less than their own employees?
It's definitely a hot topic.
Yeah, it sparks a lot of curiosity, maybe even a little frustration for some folks. Today, we're doing a deep dive to sort of pull back the curtain and understand how this is legally possible.
It's definitely one of the most complex parts of our financial system.
Hmm.
The tax code is just vast, and there are strategies, well, ways of doing things available to those with the means that just aren't really relevant for most people earning a regular salary.
Right.
So our mission today is to explore these strategies based on the information we've gathered and kind of break them down so you can see the mechanisms at play.
Exactly. And, we're not here to judge or say if it's right or wrong. We just want to understand the methods that are out there.
Yeah.
You hear people like Robert Kiyosaki or even figures like Trump and Warren Buffett discussing their taxes. And it leaves a lot of us scratching our heads. There's that famous quote, I think it was Einstein, "The hardest thing in the world to understand is the income tax."
Oh, yeah, if you found it hard.
Exactly. So you're definitely not alone if you find it complex.
And that complexity is really key. That's how these strategies work. So our goal is to navigate through some of that and explain how the rich legally minimize their tax bills.
Okay, so let's start with something really crucial, something that comes up right away. The difference between tax evasion and tax avoidance.
Yes, absolutely fundamental. You have to get this straight. So tax evasion, that's the illegal part.
Right, breaking the law.
Totally. It means deliberately, breaking the law, lying to the government, hiding income, hiding assets you're supposed to report and pay tax on. It's fraud, plain and simple.
And the examples are pretty clear, right? Like just lying about how much money you made from selling something.
Exactly. Or hiding money away. Maybe those old stories of secret Swiss bank accounts before the rules tightened up. Basically, if you're intentionally hiding money where the government can't find it to tax it, that's evasion. Illegal.
Got it. Or like claiming business expenses you didn't actually spend.
Yeah, that's another classic example. The pizza place owner claiming, $30,000 in renovations when they only spent $3,000? That's just lying to reduce your taxable income.
Illegal.
And the consequences are serious. We're talking fines, big penalties.
Even jail time. Remember Lauryn Hill? Serve time for not paying taxes on millions in income.
Wow. Okay, so just to be crystal clear, tax evasion is illegal. Don't do it. That's not what we're talking about today.
Precisely. What we are focusing on is tax avoidance, and this is completely legal.
Legal.
It's using the existing rules, the provisions already in the tax code, in smart ways to pay less tax. You could call it clever financial planning, maybe best practices, using the opportunities the law itself provides. So when we hear about wealthy people paying low tax rates, they're almost always talking about this legal tax avoidance, not illegal evasion.
That's the key distinction, yes.
Yeah.
They're navigating what the sources call this myriad of rules, opportunities, and options that the tax code offers.
All right, now for the really interesting bit. How do they actually do this legally? What are the main strategies that allow them to pay less?
Well, one of the absolute biggest differences highlighted is that the wealthy often focus on building wealth through assets, not salary.
Okay, so like owning stuff rather than just getting a paycheck.
Exactly. Most people, right, their income is mainly salary or wages.
Yeah.
Tax gets taken out automatically. That's ordinary income.
Yeah.
But for many wealthy individuals, their wealth isn't coming from a paycheck.
It's tied up in things.
Right, things like company stock, real estate, other investments, assets. Warren Buffett is the example here. He's pointed out himself he pays a lower tax rate than his secretary.
Because his wealth is mostly his Berkshire Hathaway stock, which has grown enormously, while her income is salary.
Exactly. And here's the crucial part. The increase in value of an asset, like that stock, generally isn't taxed year after year like your salary is.
Yeah.
You only pay tax on the profit that's called capital gains when you actually sell the asset.
So if Jeff Bezos's Amazon stock goes up by, say, $1 billion in a year, he doesn't pay tax on that billion until he sells some stock.
Correct. The wealth grows, but it's tax deferred until that sale happens. And even then, the tax rate on those long-term capital gains is often lower than the rates on ordinary income like salaries.
Okay, that difference alone, taxing assets differently from salary, seems huge.
It's fundamental. And it leads into another strategy that sounds, well, pretty striking. Buy, borrow, die.
Buy, borrow, die. Yeah, that definitely catches your attention. What's that about?
It's described as a really powerful strategy, mostly for wealthy families, to access cash and pass on wealth without triggering those capital gains taxes we just talked about.
Okay, break it down. Step one, buy.
Step one, buy valuable assets, things likely to grow in value, stocks, real estate businesses, art, whatever.
Standard investing so far.
Right. But then step 2, borrow. When they need cash to live on or spend, instead of selling those assets and paying capital gains tax,
They get a loan.
they get a loan using the assets as collateral, security for the loan. And because it's a loan, not income.
It's not tax.
Exactly. It's tax-free cash.
Mhm.
Elon Musk is often cited as using this approach. You can borrow against stock portfolios, real estate, even some kinds of life insurance policies. It lets you access the value without selling the underlying asset.
Wow. Okay. So they live off borrowed money secured by their appreciating assets. What's the die part? Sounds grim.
It refers to what happens when the original owner passes away still holding the asset.
Yeah.
This triggers a really important rule called the stepped-up basis.
Stepped up basis. Okay. What does that mean?
So cost basis is normally what you paid for an asset, right? If you bought stock for $10 and sell it
Yeah.
for $100, your taxable gain is $90.
The profit.
Right. With stepped-up basis, when an heir inherits that asset, its cost basis for them gets stepped up to whatever its fair market value was on the date the original owner died.
Wait. So if the stock was bought at $10 and it's worth $100 when the owner dies, the heir inherits it and their basis becomes $100.
That's right.
So all that $90 gain that happened during the original owner's lifetime just vanishes for tax purposes.
Effectively, yes. For capital gains tax purposes, it's wiped out.
Okay.
The heir would only pay capital gains tax if they later sell it for more than $100.
Whoa! That's
Yeah.
a massive tax break for inherited wealth.
It's considered one of the biggest ways significant wealth is transferred between generations tax efficiently. So borrow against it to live tax-free, and then die holding it so the heirs get that stepped-up basis.
Incredible. Okay, what about people who own businesses? That must open up different doors.
Absolutely. Owning a business provides a whole range of ways to legally reduce taxable income. A core principle is business deductions and reinvesting.
Okay, deductions, like writing off expenses.
Exactly. The golden rule mentioned is basically, you can deduct any expense that's ordinary and necessary for the business to function. Money spent on the business reduces the profit the business is taxed on.
So things like office rent, supplies.
Yep. And technology, laptops, software, phones, business travel flights, hotels, setting up a home office space, utilities like internet if used for business, health insurance premiums for employees, even business meals sometimes.
So the more legitimate expenses you have, the lower your taxable profit.
Correct. And tied into this is the idea of reinvesting profit. If the business makes, say, $5 million in profit.
Which would normally be taxed pretty heavily if you just took it out.
Right. But if you instead take that $5 million and reinvest it back into the business, buy new machinery, expand operations, hire more people, that reinvested money generally isn't taxed as profit in that year.
Ah, so you use the profit to grow the asset, the business itself, tax-free, rather than taking it as taxable income.
Precisely. It allows for much faster company growth and increases the owner's net worth through the increased value of the company without an immediate tax hit on those reinvested funds.
That makes a lot of sense for entrepreneurs. Okay, what about getting more complex, using different company structures, maybe internationally?
Ah, yes, that's a big one. Using companies and structures, especially across borders. One key tool is the Controlled Foreign Corporation, or CFC.
CFC, what's that?
It's essentially a subsidiary company set up in a foreign country, often one with low taxes, that's controlled by a parent company back home, say, in the U.S.
So setting up branches overseas?
Sort of, but strategically placed. Apple's use of Irish subsidiaries is a classic, though complex example. For a while, they managed to structure things so that profits were attributed to companies that weren't considered tax resident anywhere, or were taxed at very low rates by exploiting differences between countries' rules.
Playing the gaps in international tax law.
Finding the legal seams, yes. Another related strategy used by tech giants like Google and Facebook is transfer pricing.
Transfer pricing sounds technical.
It's about the prices charged for transactions between different parts of the same multinational company. A common tactic is to have a subsidiary in a low-tax jurisdiction, like the Cayman Islands or Bermuda, own valuable intellectual property patents, brand names, algorithms.
Okay.
Then the main company, say in the U.S. where taxes are higher, pays huge licensing fees to that offshore subsidiary for the right to use the IP.
And that fee is a business expense for the U.S. company
which reduces its taxable profit in the U.S.
and shifts the profit legally to the low-tax country where the IP is held.
Exactly. That's transfer pricing in a nutshell,
Mhm.
shifting profits through internal charges. Now, getting that money back to the parent company can trigger taxes, unless there are things like tax holidays or reforms, like one in 2018 that encouraged repatriation at lower rates.
Wow, that requires some serious global planning. Okay, shifting gears a bit. What about passing wealth when someone dies? You mentioned buy, borrow, die, but are there other tools?
Yes. Besides the stepped-up basis, using trusts is crucial for managing estate taxes for the very wealthy.
Estate tax. That's the tax on your total assets when you die.
Right. And in places like the U.S., it can be quite high, up to 45% mentioned in one source, above a certain, admittedly very high, exemption amount.
Nearly half. That's significant.
It is. So by putting assets into a properly structured trust, those assets are legally removed from your personal ownership. They belong to the trust.
So they're not counted as part of your estate when you die, meaning no estate tax on those assets.
That's the goal, yes. The assets are held by the trust for the beneficiaries, outside the deceased's taxable estate. Trusts also offer other benefits like asset protection from creditors and controlling how heirs receive the wealth over time.
Okay, so trusts are a major tool for avoiding that big inheritance tax hit. What about giving money away while you're still alive? Charities.
Absolutely. Charitable foundations are another key strategy.
Yeah.
Donations to registered charities are generally tax deductible.
So you reduce your taxable income by giving money away.
Correct. And many wealthy individuals establish their own private foundations. They donate money, getting a tax deduction, to their foundation, which then distributes funds according to its charitable mission.
So they control where the money goes, essentially.
To a large extent, yes, within the rules for foundations. And the foundations themselves have operational expenses that can be deducted. You can also donate assets, not just cash, land, art, vehicles. There was even a mention of potentially donating things like cars or art, and maybe still retaining some use, though that can be a tricky area legally.
Interesting. Okay, is there a way to get paid for work that avoids immediate tax, unlike a salary?
Yes, for founders, executives, or key employees, receiving equity instead of a large salary is common.
So getting paid in company stock instead of cash.
Exactly. Stock options or grants. The value you receive in equity generally isn't taxed immediately like salary is.
When is it taxed?
Usually the main tax event happens when you actually sell that stock later on.
And if the company does well, that stock could be worth way more by then.
Precisely. It allows you to build wealth, potentially significantly, based on the company's success, with the tax deferred until you cash out. Again, it aligns with that theme of wealth growth in assets rather than immediate taxable income.
Got it. What about physical things a business owns, like buildings or machines?
That's where depreciating assets comes in. Depreciation is a huge accounting concept for businesses. It allows them to deduct the cost of major assets, buildings, machinery, vehicles, equipment, not all at once, but spread out over the asset's expected useful life.
So you buy a $10 million factory. You don't deduct $10 million in year one.
Generally, no. If its useful life is, say, 10 years, you might deduct $1 million each year for 10 years. This annual depreciation charge reduces the business's taxable income each year.
Even if the business is making money.
Yes, it's a non-cash expense on the books. So a business could be generating positive cash flow from its operations, but after accounting for depreciation and other expenses, it might report little or no taxable profit.
So depreciation significantly lowers the profit figure that gets taxed.
Very significantly, especially for businesses with lots of physical assets.
Okay, are there simpler strategies, like just moving?
Well, simple in concept, maybe not in practice. But yes, strategic residency is a factor. The most direct way is moving residents entirely to a country with zero income tax.
Like Dubai, Monaco.
Exactly. Places like Dubai, Monaco, the Cayman Islands, the Bahamas. If you legally establish residency there, you generally don't pay income tax in that country. Of course, these places are often very expensive to live in, so it usually only makes sense for the very high earners.
Makes sense. And what about classifying assets? You mentioned yachts.
Yeah, that was an interesting one. Claiming assets as homes. Tax rules often treat primary and secondary residences differently than, say, pure investments. The sources noted that things like yachts or large motorhomes, if they have sleeping, cooking, and toilet facilities, might potentially qualify as a second residence under certain tax codes.
So you could potentially get mortgage interest deductions or other home-related tax benefits on a boat?
Potentially, depending on the specific jurisdiction's rules. It highlights how definitions in the tax code can be used strategically. There was also a brief mention of more complex, maybe shady strategies like juggling multiple passports to try and avoid having a primary tax residence anywhere, but that's generally seen as risky and hard to sustain.
Right. Okay, one last one. Just giving money away to family or friends.
Yes, gifting money has specific rules. Most systems, like the U.S., have an annual gift tax exclusion. It means you can give up to a certain amount per person per year without any tax implications or needing to file a gift tax return.
What was that limit?
One source mentioned $15,000 per recipient per year as of 2021. On top of that, there's a much larger lifetime gift exemption. It was $11.7 million in the U.S. in 2021, according to one source, which allows you to gift substantial amounts over your lifetime without paying gift tax.
So you can legally transfer significant wealth tax-free using those allowances?
Yes, within those established limits. It's another tool for managing wealth transfer.
Man, that is a lot. An incredible number of ways the system works differently depending on how you structure your wealth and income. It really begs the question. Why? Why does the system allow all these opportunities?
That's the multi-billion-dollar question, isn't it? The sources suggest several overlapping reasons. One big argument is that many of these provisions are designed, or at least justified, as incentives for economic growth.
How so?
Well, the idea is that business owners create jobs, real estate investors build housing and infrastructure. So the tax code offers breaks like deductions for business investment, lower rates on capital gains, depreciation to encourage activities seen as beneficial for the overall economy, rewarding risk takers and investors.
So it's like, do the stuff we think is good, and we'll tax you less on it.
That's one perspective, yeah. Another huge factor is just the sheer complexity of the tax code. We've only scratched the surface, but it's thousands and thousands of pages, a myriad of rules, opportunities, and options, as one source put it.
And navigating that complexity requires expertise.
Expensive expertise. Accountants, tax lawyers, financial planners who specialize in this. The wealthy can afford to hire the best minds to find every single legal deduction, credit, and strategy available within that complex system. Most people can't.
So there's an access to expertise gap.
Definitely. Plus, there's a legal viewpoint that taxpayers aren't obligated to pay the most tax possible. They're entitled, actually maybe even expected by shareholders if it's a company, to arrange their affairs to pay the least amount of tax legally required.
So using these strategies isn't seen as cheating the system, but as following the rules smartly.
Within the bounds of the law, yes. What one person calls a loophole, another calls a best practice or an intended incentive. And once these rules are in place,
They're hard to get rid of.
very hard, because of lobbying. Many of these provisions benefit powerful industries, real estate, finance, tech, agriculture, you name it. Those industries and companies spend a lot of money lobbying politicians to protect the tax rules that benefit them.
So political influence keeps the system complex and preserves these advantages.
That seems to be a major factor, yes. And finally, one source also pointed towards potentially lax enforcement by tax authorities, like the IRS, especially on the most complex returns of high-income individuals and corporations, as maybe contributing to the gap between taxes owed and taxes actually paid.
So it's a mix. Intentional incentives, built-in complexity, the cost of advice, legal interpretation, powerful lobbying, and maybe even how strictly the rules are enforced.
Wow. It's definitely not a simple picture. And it fuels this constant ongoing debate about fairness. You see tax the rich trending online all the time.
And politicians respond, right, proposing changes.
Absolutely. You hear proposals like from President Biden's administration to target specific things, close the stepped-up basis loophole, increase capital gains tax rates for the highest earners, raise corporate taxes.
But then there's pushback.
Always. Arguments that raising taxes on capital or businesses will discourage investment, slow economic growth, maybe even drive activity overseas. It loops back to that incentive argument. It's a fundamental tension.
So a constant push and pull over what's fair versus what stimulates the economy.
Precisely. And looking even further ahead, one source floated a really interesting, maybe futuristic idea. Potential disruption from technology like blockchain.
Blockchain, how would that affect taxes?
Well, the speculation is that increased transparency from blockchain-based systems could, maybe, change how taxes are collected and allocated, perhaps giving individuals more direct say in where their tax dollars go. Like, you could choose to allocate more to local schools versus national defense, for example.
Whoa, that would be a radical change.
Highly speculative, of course, but it shows people are thinking about fundamentally different models for the future of taxation.
Wow. Okay, this has been an incredibly eye-opening deep dive. It really puts things into perspective. Why we hear those headlines, how wealth management works within the legal framework. We've touched on so much. Assets versus salary, that buy, borrow, die strategy.
Business deductions, reinvesting profits, complex offshore structures, trusts, foundations, equity, depreciation.
Even moving countries or, yeah, classifying your yacht.
Right. And understanding these mechanics, it's not really about endorsing them or criticizing them here today, but just seeing how the system is set up and why it produces different outcomes for different people.
It definitely gives you a completely new lens to look through. So, thinking about everything we covered, what strategy or maybe reason why the system is this way stood out most to you listening?
Yeah, we'd genuinely love to hear your takeaways.
Let us know in the comments below. And if you found this deep dive on Marginal Thoughts insightful and you want more complex topics broken down,
Make sure you hit that subscribe button.
you won't want to miss our future explorations. Thanks for joining us.